All right, guys, welcome back. Let's get into these charts, figure out what's going on today, and try to keep an eye on the bigger picture. That's what I want to do. We're in this grind session right now in the market where it's not moving up too much. It's not really moving down. It's just chopping sideways. So we want to always take into consideration the bigger picture and not get caught up in the day-to-day and the hourly charts. This is micro stuff. You want to understand the bigger macro picture to help at least influence the your trade ideas and the trend. You need to understand what the larger trend is so that the smaller trends can be taken into context in the larger trend. Before I get started, give me a thumbs up. Just hit that thumbs up button right now. I really do appreciate that. And let's go ahead and get going. All right, S&P 500. So here's what we got going on right now. It's a slow week, slow day today. It's a short holiday week, so you can expect a lot of chop. But here's this trend line. We can't say it's super clean yet. We only have a couple data points, but maybe we have this downward trend line here that we just broke. I just want to kind of point that out. Since we only have a data point here and a data point here, it's not enough to say that it's a valid trend line. But I want to leave it up in case today they roll over and it fails, and maybe that holds as a valid trend line on the daily chart. So something to watch for. And if we break down right here, that sets in motion the continuation of lower lows, lower highs. So here would be your high right here of the recent breakdown. And then we had the kickback rally that's put in a high here. And then when it did another kickback, you can see it got a little lower. Didn't quite get that high. And then today, if we fail here or somewhere close to here, maybe kick back a little bit higher up to 312, then that would be a lower high. But we're not getting the lower lows yet. So we are getting lower highs. There's downward pressure when we get up near the highs, but we're not getting the lower lows yet. So maybe that's a sign for the next big sell-off. And we have the big gap down here to fill down here at 286. So I do expect that to fill. I do think that we're going to roll over and fill, and then we'll have to evaluate what's going on down at that level. But again, we have to continue to watch it. And the charts are going to tell us what it wants to do. So again, today is primarily a FAANG day. They're buying FAANG, holding the market up. You can tell because here's your Qs. And this is something I want to actually point out. I spotted a while back, and maybe it plays out. If you go to the weekly chart on the Qs, which will really give you the bigger picture, here's your bull market in tech. And you can see that we're in a bull market the entire 10 years. And then in 2018, the Fed had to save it. And then again in 2020, the Fed had to save it again. Both of these dips were, the Fed is really trying to fight any kind of asset price correction. So they've managed in this last stimulus and all the money printing to pop the Qs up to its weekly resistance trend line. So you can see here, this is the trend line on the weekly that it held as resistance. It's been the channel for the entire bull market, and you can see it's right in here. Now it's a weekly chart, so the levels could be slightly off, and we held resistance here. Then in February, we popped up to it, and this is where we tagged it and rejected. And then again, we're right up to it again right here. So this might prove to be the resistance area, or another scenario, we might have a melt up or blow off top in this rally. And if that happens, maybe the Qs just shoot straight up beyond the channel, and that would be your blow off top. And at that point, we would correct, sell off, and probably have a sustained sell off in the Qs, making our way, probably for a pretty big downside move. But again, we don't know. At this point, all I know is it looks like we're right here at resistance within this price channel. So we'll have to wait and see how this plays out. But watch for some sort of a rejection up around here. Maybe it plays out in the Qs. Going back to the Exxon or to the SPY, just bigger picture, this could easily still be a bear market rally. And we have not, the SPY, which is the stock market, has not recovered the all-time highs. Neither has the financial sector or the small caps. There's lots of sectors that have not recovered the all-time highs, and it really is just tech. I mean, ultimately, it's just XLK, triple Qs. It's really just tech that is moving higher, and the rest of the market is not. So that's something to keep an eye on. There's a divergence right now with tech and with the rest of the market, and really with the economy. So watch for tech that, when tech breaks or starts to fail, there's relative weakness in the rest of the market. So that could set up for a pretty big move to the downside if tech fails or when it fails. Let's look at tech. Here's Apple. Again, just an upward price channel. It just continues to move higher. So there's nothing there to short. Not very objective to go long because you have negative divergence in the PPO and the RSI. So it doesn't make sense from my perspective to go long. But again, it is in an uptrend. So we have to continue to respect that until it's broken. Microsoft. So this is a big part of why the market's kind of rallying today. It's not rallying a lot. It's just really sideways. But Microsoft is moving higher. Here's your channel. Here's your uptrend line. Again, negative divergence. So it doesn't make sense to go long from my style of trading. But again, you have to respect the up channel until it's broken. Here's XLV, continuation of the sideways trading channel, just chopping up and down. This is just not very conducive for swing trading. In fact, it's the worst scenario you can have for swing trading. So we just have to continue to wait for some sort of direction the next move. As of right, for day trading or a few days, yeah, you can buy it at support, sell it at resistance. It's in the channel, but we should get some sort of a breakout or breakdown sometime soon, and that will most likely come with the next direction in the general market as well. Just to point out again, Walmart, continued relative weakness. Here's your hourly chart here. We're kind of flagging a little bit. It looks like we just got this little uptrend line we've been flagging out on. So a breakdown of this sets us in motion for the next leg lower. And, that's probably going to get us down to this 113, about right there. About 114 or so. And then, we'll have to see what happens. But ultimately, we've got the bottom of the wedge, and we continue to approach it. So I think we're going to head down to this 105 to 108 area sometime relatively soon. And you can see we're down today while the general stock market is up. So continuing the relative weakness. And that's the story on that one. Kind of watching this Redfin for signs of a breakdown. It's at the point now where I think we'll get some sort of a breakdown, but this thing's just been pretty robotic, really. Just nice, clean up channel, breakdown, resume another new secondary up channel, and it's just very, you can tell the algorithms are trading this. It's just very clean. So looking for a breakdown now, and you have to wait till you get it, but I think when it comes, we should get a pretty impulsive move down. And I see our support level is right about there, about $30, $30.50. So looking for a breakdown soon, and maybe we run down to $30, and that's about a 25% gain. So we'll look to take that trade when we get that breakdown, but we have to wait for it. And this is an hourly chart, so you can follow along, and I'll be looking to jump on this trade when we get that breakdown. Facebook. So this is another reason why the market's rallying. Facebook's up 5%. It recently dipped on some bad news, broke support, but that proved to be a false breakdown. So one of the reasons why I wasn't really interested in shorting this, because, and I said in the other videos, is the other, basically XLK and QQQ hadn't broken down. So you have Facebook breaking down, but you have the general indices, the tech sector indices, still holding strong. So you're going to get money flows into Facebook, even though it broke down. People are going to continue to buy QQQ and XLK, and that money's going to flow into Facebook, and that's going to put a floor basically underneath this. So that's why you're seeing the rebound rally, false breakdown. Essentially, it was a bear trap, and this continues to hold above support now. So, that's bullish in general on Facebook. Okay, XOM, which is Exxon Mobil. You can see here we had this hourly breakdown right here, or this down channel. We broke it, not super impulsively, and now we're getting back tests. So, this is potentially an objective area to go long around the 43.70 level. And we'll have to wait and see, but it is a potential area to go long. I'm not going to take it probably because I see in the SPY, I see, that we're still in a downtrend in the SPY. And that comes from the breakdown here. We still have the candle, the island cluster top reversal candle pattern right up here. This is your island, and this is your reversal or your big sell signal. And now we're just getting this consolidation period. But I think this sets us up for further move to the downside to at least fill that gap down here at this 286. And XOM will probably sell off if we get that in the SPY. So not fully interested in this one quite yet. Although, there is bullish divergence. You can see it right here. If I can get my line, there's your bullish divergence right there. So we were making lower prices while the momentum indicators were bullish. So, this could hold 43.70. It's a possibility. Moving on. Something to pay attention to. I'm noticing the big banks are pretty weak today, even though the XLF, if I flip over to this, is bearish. You broke down. Here's your break of support right here. You broke it right here, and then this has been back testing, and now you're starting to roll over. So the big banks are signaling they could be forecasting future weakness in the market and the SPY, and the big banks are leading the way down. So you can see here JP Morgan's down today. About 1%. You've got Citibank down 1.5%. Wells Fargo down 2%. Capital One, it's down 3.5%. So the big banks are actually getting hammered pretty good. Let's look at JP Morgan here and see if we can see anything. I mean, clearly the thing is that when people say that the market is in a bull rally, they're just looking primarily at tech, I believe, because tech continues to make new highs, and there's so many retail traders that are crowded into Apple and Microsoft that they see the gains in those few stocks and they feel like the rest of the market is in a bull market or continuing the bull run because they see gains in their personal accounts. But that's such a thin, narrow way of looking at the market that, yeah, you have gains in those couple stocks, but if you're not looking at some of the other things and the other sectors, then you get caught off guard, and that's how you end up, having huge drops in those few tech sectors because everybody's crowded into those couple stocks, and you don't notice the weakness in the rest of the market, and then all of a sudden, you have a 30% drop in those tech stocks because everybody. You start to have weakness, and because there's crowding in there, everybody rushes for the exits all at once. And that's how the general public pretty much reacts, is most of the time they'll tell you you're in a bull market because they're making money in a few stocks, and then they have a big sell-off, and they think the selling's never going to end. And really what I try to do on this channel is anticipate the move before it happens. So the move hasn't happened yet. I'm just looking for it, and I'm looking for signs that there will be a big sell-off move in tech, And I see things like this where the banks are starting to get weak. The banks are not in a bull market anymore. If I go to JP Morgan, you look at the weekly chart here. Let's go back to 2000. Here's 2009, and you can see that the low here, there's your bull trend right there. From 2009 lows on the weekly chart, it's rough, but it's right in there. You can see lots of reactions here, reaction here, lots of reactions right in here. And then we broke, and this is your back test. So you broke the bull trend right here just this year, actually, We hadn't broken before, but the bank, JP Morgan broke. We did a back test all the way up, close to the trend line. And then now we're starting to sell off. So this is, not a bullish chart. It was bullish while you were in trend, all the way going back to 2009. It was bullish, but now that's no longer bullish. And this is a weekly chart, so this is big picture stuff. I mean, if I look at the monthly chart, you can see it clearly shows that JP Morgan's not in a bull trend anymore. Here's your bull trend. There's your breakable trend. There's a nice back test. Look at that candle in the wick. Ran all the way up there to do a back test and rolled down and sold off in that month. So that's a doji candle on the monthly chart, which tells me that there's a lot more weakness in the big banks to come, and we're in a bear market in the big banks. So I would look, it's going to be really hard for the rest of the market to continue to rally if the big banks can't rally. That's your credit centers. This entire economy is based on credit. It's consumer spending, it's borrowing and spending. And if the banks are continuing to show weakness, then it's going to be very hard for the rest of the market to rally when the lifeblood or credit starts to tighten up. And it already has started. The banks have already started to tighten their lending standards. And when they start tightening their lending standards, there's not as much money that is being borrowed and spent into the economy, which creates recession. So this is just something to look at. That's some fundamentals there, but at the same time, the technicals are lining up with that as well. So that's very interesting to see, and I'm sure I could see the same thing. I mean, Wells Fargo is one of the weaker banks, but if you look at, here's the monthly chart in Citigroup, and if I roll back to the 2009 lows, going back, this stock, this has never really recovered, but here's your 2009 lows right here on the monthly chart, and this one's not as clean, this Citigroup one, but JP Morgan is definitely, I think, the one to watch. You can see you've got a little bit of a trend there. The JP Morgan chart's a lot cleaner and shows exactly what's going on, but Citigroup still looks weak. So something to pay attention to. I think that's important to watch. That's where I'm going to end the video, guys. Give me a thumbs up. Really appreciate it. Talk to you on the next video. Bye.